Welcome to the HyperFast Wealth Show. On this episode, we have an amazing guest who has closed over $2 billion, that's with a B, $2 billion in real estate. He has a new course out teaching people how to flip mobile homes and has a new fund for people that want to get into investing in mobile home parks. Welcome to the show, Jonathan Tuttle. All right, welcome to the show today, Jonathan. How are you doing?
I'm very good. Thank you for having me.
Yeah, and where are you calling in today from? Just so everyone
Chicago,
knows.
Illinois.
Chicago. All right, well, welcome from Chicago. We're glad to have you on the show. Before we jump in to what you're doing now, which I think is really, really exciting, and it's one of the hottest areas probably in real estate investing. Why don't you give folks out there who are listening, watching, a little bit of your background and how you got to where you are right now?
Sure. So I was always an entrepreneur, even as a kid. I remember just even when I was like 5 or 6 year old, I would go door to door with my little red wagon and sell flowers from our yard to neighbors, then take that money to buy toys at Toys R Us. I always worked as a kid. And then as I got into my 20s, I did retail at BB, the clothing store, and ended up being the #1 seller in the country. But at the same time, my dad got his first mobile home park. We did together. So that what's really got me into that space, because I was around 2006-07. And then right after that, the housing crash. And that was the only asset, because my dad was a developer, a contractor. It was his only performing asset during that downturn that made us get us past that. So that's what really drew me into the whole space. Started brokering real estate around 2010, luxury, and then just quickly flipped over to commercial, which I really like the moving parts of commercial real estate, and then quickly pivoted into just focusing on mobile home parks. Fast forward a couple of years, I started, the fund. So we focus on acquisitions of parks with accredited investors. Then also for non-accredited investors, we have a course teaching the everyday American how to flip mobile homes.
So how does that work? Like, a lot of people I think out there probably hear mobile homes and get scared or think of, I don't know, whatever stereotypes, myths are out there, right? But what's it like? Like, what's the typical mobile home deal look like as an investor?
Yeah, it's a great question. There's two aspects to it. There's the investing into the park component, and then there's also flipping the homes. And that's exactly what you said, is like, it actually becomes a good thing, because if it sounds kind of weird, or if it sounds, unique, it throws a lot of people off and it turns them off. So like, that actually works to your advantage as an investor, because you're not competing. It's more blue ocean when there's less people going after the same thing. This year has really proven that, manufactured mobile home parks, like you said in the beginning, Green Street Data, which is like an independent third party for commercial real estate, the top performing real estate for this year by far was mobile home parks, and a 12% increase in value. And I mean, you saw obviously malls, hotels, a lot of the real estate asset classes have been getting crushed from COVID because, the complications, you can't even be open in some states, as everyone knows. So the value to it is, if you're flipping the mobile homes, it's the easiest and cheapest form to get started with. You don't need a lot of capital. Unlike a single family, well, you don't need to go get you don't need a 720 credit or 700. You don't need to put down 20%. You don't have to go to the bank to get a loan. You don't have to have, if you're remodeling or flipping, fix and flip, you're not tearing down walls and discovering there's mold and there's all this crazy things. It's not much you have to do, because it's basically just like a box with some. So
are you talking about flipping the individual unit, like one trailer?
Yeah, there's two components.
Not the whole park, right? Just to clarify. So.
Yeah. So we have like the fund, we acquire the park and bring in better operations. That's for accredited investors. That's what our main focus is. But also at the same time, I had a lot of people asking me, I'm not a millionaire, because you have to have at least $1 million liquid to be a accredited investor or make 200 plus a year. How can I get from, 7,500 grand? And I want to get involved in this real estate. Well, the best avenue is flipping trailers, because a 70s, 80s trailer, a couple grand, 5-10 grand is the easiest way to get started, learn the business, and also make some money, and also provide affordable housing to everyday American. there's 60 million Americans that need affordable housing and only about 12 million mobile homes out there. So you
So
have this huge demand.
how do you buy the actual trailer? Like, how do you even find them? Is there like an MLS or a Craigslist or something? Or
Yeah, great question. Like, well, Craigslist is actually one of the better angles. Craigslist, also Facebook Marketplace is really untapped. And then the traditional, like if you're a real estate agent, the physical for sale by owner, just drive around local parks, get a list of all the parks, drive through. If you see a sign that says for sale by owner, you know those are going to be great opportunities because it's probably somebody that doesn't know how to market it and they don't know how to price it because like there's not a lot of data out there. There's not like there is a few in the MLS, but it's most real estate brokers do not want to spend time, marketing a $15,000 house and they can market a $300,000 house and make 15 times the money. So it's not worth it for them to gas time effort to make a couple points on a $15,000 house. And then also the person that owns the trailer for the mobile home, they don't really want to have a real estate agent, giving them the 5 or 6 points. It's a lot of money out of their percentage. They'd rather just get it bought and sold and get done with it and move on to the next place they're going to.
So how, and you mentioned you don't have to get a loan or it's a lot easier. Like how are people doing this with credit card or some other type of loan, or how are you buying your $10,000, $15,000 trailer that you're going to
flip? You could use, great question. You could use credit card, local credit unions in small towns. Credit unions or local community bank will usually lend on them. And the thing is they move really quick. Unlike a traditional fix and flip, if you're flipping a mobile home, there's such a demand for mobile affordable housing. And every time there's a recession or downturn, people move back. If they're making 10, 15 bucks an hour, it's the only option they really have. So you always have this huge demand. So when you list a new mobile home or flipping a mobile home, it's 3 or 4 weeks. You're getting 30 requests, to see it. And 2 or 3 of those would be like ideal prospects. So you don't have that huge, you're fixing and flipping a house. It's going to take, 2 or 3 months, unless you have like your own crew and you have really systems of process. You're in and out on that property in 3 or 4 weeks max.
Are you usually taking over a lease, or if you buy it, is it normally sitting in a park already where it's going to stay, or are you moving them around? Or
that would be the ideal. Because ideally most of these mobile homeowners have these, they developed in the 60s, 70s, and 80s. Most of the majority of the parks, because they've another advantage we own the park is the zoning stipulations don't really allow new parks. There's only been about 10 new parks developed in the last like 20 years based on most of the data, or there's some like hybrids where it's like an RV component or self-storage component, but it's not really a true fully mobile home park. The cities don't like them because A, the stigma, also B, it's the lowest form of taxation. And usually the real estate, they could charge a lot more for other asset classes, which they could, better tax bases for them. So they don't want that the lower taxes for the city. But for the mobile home component, there's a couple of angles to it. So this is the kind of the gray area. It's basically like a car. It's a VIN, you have VIN and title. You kind of like flipping cars, and you don't really want to move them. I mean, there's different, you could have different business models, but ideally, instead of hiring a transporter, licensed insured, finding another park, it costs between $5,000 and $10,000, to unhook it, do all that, get all the license insured, get the transporter, which is a big semi, and move it to another park, and then find another park. It's a lot of extra headaches and work that's not really necessary, and especially when the asset's only worth, if it's a 70s mobile home pre-HUD, it's only worth $10,000, $15,000, if that, maybe $5,000. So you're spending more on the transport than the actual home is worth. The play is really, for these park owners that, that, like I said, alluded to, is 60s, 70s, they've been developed. They've been there for 40 years, some of these homes. Come in, put some new carpet in there, paint the walls, deck, new skirting, make sure the roof is good. And just the average in these small towns where most of these are second tertiary markets, it's just a quality affordable house. Like they rather pay $300 lot rent and save $300 or $400 in insurance, or not insurance, but in taxes, compared to that house that's $1,500 a month. It's usually 1/3 of the price of a house. So it provides affordable housing. And then if you bring in all new carpet, some new appliances, the interior, as long as it's like, 12, 14 feet wide, it's decent, it's, decent size. It just provides that quality place of living. So you don't have to put a lot of money into it. It's not really complicated, just fixing, some minor cosmetics in the inside, and that person's super happy. Like less is more, basically, in most markets.
What's the typical rehab cost when you're fixing them up?
Yeah, it depends on the year. Good question. It depends on the year. If it's a 70s, 80s, like 1976 is when HUD came out and had pre-HUD homes, pre-1976, anybody could develop and manufacture housing. Right now, there's about 100,000 mobile homes manufactured new per year. Clayton Homes, which is Warren Buffett's company, they produce about half of those, around 48 to 50,000 every year for like the last 5 years. But the pre-HUD homes, the biggest opportunity is the 70s, 80s. You could fix those homes. 80s actually from 85 on newer. Their interior, everything is it's quality living. From like the 70s to like 85, you still have to, I'd probably say it's all case by case, just like any house, but it's probably $3,000 to $4,000 if you really want to like put a new carpet, new skirting outside. And if it's 80s on up, you could sometimes get away with like $1,000 or $2,000, depending on the shape and how the person maintained it. So it just all depends on, the condition of the unit. But the thing is, there's not many curveballs. Like the whole outside, for example, it's basically a box. You can't change the outside of the box. Like you can't say, oh, I want to put a huge new front door, because if you do that, the structure of it, it's going to make the walls collapse. So you can't be like, oh, I want to have this new, twice as big as windows. I want to add an extra window on the outside. That'll actually make the whole thing collapse. So you don't want to do that. So you don't have those challenges.
So what's your typical, deal? Like what are you buying them for? How much are you putting into them? And then what are you selling them for in the end?
And it all depends on the market. So like Florida, California, you have the senior parks in Florida, the 55 and up. Those are really hot. California, where you have the shortage of affordable housing. California, like they have parks out there like the Malibu, Paradise Cove, or Matthew McConaughey, some of the Hollywood live at. They have homes that go between 4 and 6 million. It's just crazy. And then you also have the Montauk Village, I think it is, in Long Island. That one, I think those go for 1 to 2 million. That's where like they have like the billionaires living there. So there's all kinds of different parks, but the majority of the parks are just affordable housing. So if you have a 70s unit in the Midwest, you get them for, it all depends on your acquisition cost. So if you're doing FSBOs and driving around, you're most likely get them for, you could flip the contract and say, hey, I'm going to come in just like a real estate agent. I'm going to market it for you. I'll pre-qualify the people. You don't have to pay a broker. And then you basically get that arbitrage between the, whatever you want to mark it up between. And those you get, a typical deal, you want to make 5 to 10 grand in like a 70s unit. That's plausible. If you put money into rehabbing it, 10 grand's, more plausible. But if you're in California, you're in Arizona, Texas, and like the stronger markets where they have, shortage of housing, affordable housing, you're getting, you can make 15, 20, 30,000 a flip, or California, you can make 75 to 100, just like a regular house, because the mobile homes are going for 200, 300, 400,000, even besides those multi-million-dollar ones. So it all depends on your market and what the affordable housing need is. And
now, are those much nicer mobile homes, bigger or more expensive? Like why 200 grand for a box? I get the differences in land value between some of those areas, but if we're just talking the box, like what makes it go from 20 grand to 200?
Just the real estate. Because if your average house in California and like a low income house is $1 million, the mobile home's not going to go for 5,000. It's kind of like, it goes based on real estate principles in that regard, because there's such, a normal house, to say in Illinois or in most markets, Midwest, like an average house is $250, but in California, that same house is $1 million. So the mobile home, and then 250, where the houses are 250, the mobile home will go for like 10,000, but that you get the same, price gap in California because of the fact that the real estate's so much more expensive. They could charge more for, it's basically supply and dynamic economics.
Gotcha. Well, it certainly seems like this is a huge opportunity, especially for people that maybe don't have a ton of resources to throw at, like bigger, more expensive ones. I mean, if you can get an asset for 10 to 15 grand and make 10 grand on it, that's pretty good percentages.
Yep.
Overall. And I think you mentioned earlier, you've got a course to help people learn more about this, right?
Yeah. So because I have the fund, it's for accredited investors. That's only about 12% of the market, which, accredited investor, you have to be $1 million in liquid, not including your house, or 200,000 a year. And so I really want to help people, because I have friends that wanted to get in the space. I'm like, well, I can't teach everyone one by one. What's the easiest way to help provide this? And at the same time, it helps industry, because if these older homes get torn down and they bring in new homes, it really defeats the fact, because a new mobile home is $50,000, $80,000, $100,000. So, which is still affordable for most of us, but not everyone, the average American makes $33,000 a year. So that 15 or 20,000 mobile home is their lifeline. Like, they would much rather pay for a recently remodeled $15,000 home than $80,000. It gives them that, cushion to spend on food and everything else. So it really helps the affordable housing niche. It also helps, one other thing that I mentioned is these park owners that have had it for 30, 40, 50 years, they don't really, they're like baby boomers, they're 60, 70, 80 years old. They don't want to sit there and hire a team. Most of these small mom and pop owners, they don't want to sit there and actually do the work or manage that. You come in and say, hey, I'm going to come and help. I'm not taking out the park. I'm going to beautify your park so it's going to make your other neighbors want to keep their units clean. I'm going to make it more appealing to other people. And best of all, for the park owner, they just want the rent. The rent is what makes the equity. And the equity, an average home on a park is worth, depending on your market, $30,000, $50,000, even if the home's worth $10,000. So if you keep 5 new homes on there, that's $250,000 to his pocket, plus the monthly cash flow, 300, 400, 500, whatever it is per market. So he doesn't really care that you make 5 or 10 grand a flip. He loves the fact that you're keeping the unit in the park. He doesn't have to spend any CapEx. You're making the neighbors say, wow, this is how it should be here. I want to, fix mine now. And on top of that, you bring in a better quality tenant. And then at the end of the day, the person that comes in, now they get a brand new, remodeled house for 15, 20, 30, whatever it is the market entails. So it really solves all problems. And the course is called Mobile Home Wealth Academy. And it really goes step by step. One thing I want to do differentiate from other competitors, a couple other courses out there, is literally because I have the fund and I've been in the space 15 years and I'm really bringing on some of the biggest players that don't do interviews, are really hard to get a hold of. And I want to give a really inside perspective, not just as an investor side, but also teach them how to become owners of parks, because that's when you really make, you get a small park, you're making $1 or $2 million in, net worth just acquiring the park. So we want to show them a path, not only solve affordable housing, but step by step teaching them all the best avenues to get into the space, the easiest and fastest way possible. But also the bigger picture is, hey, eventually I can show them a couple different ways how to get their first park. And that's when you start getting the real big capital. And that's when you really build your net worth.
Well, I do want to get into the fund and buying the entire park or how that works as well. But how can people find that course if they want to get that course?
Sure. So we have 2 funnels. I haven't put those out because the course doesn't launch. I don't know when this airs, but until mid-January. But it's called Mobile Home Wealth Academy. That's just the basic.com. That's just the basic login page. I'm going to actually make that a little more improved, but mobilehomewealthacademy.com.
All right. So then go to mobilehomewealthacademy.com.
Yep.
And check that out. Now let's talk about the strategy and what you do with, buying the entire mobile home park.
Sure. Yeah. So this is exciting for both angles, because if they in the course, they learn how to, build a relationship with the owner. Sometimes look at seller finance, where they'll actually hand them the park because the kids don't want it because they've been involved with it and they just want to, take the money and run, basically. But for the investor side, this is the most exciting aspect, real estate right now, because Wall Street Journal did an article in January, February of 2020, and it said this real mobile home parks have been the top performing real estate by far, or even one of the best, almost like a tech-like return for the last decade. And then also, if you look at the bank data for the last 50 years, it's been the top performing, lowest failure rate from even bank data. Self-storage is a close second, but the thing with self-storage is you could build those. There's no zoning. You could hey, I buy this land right here. I could, convert this Kmart into self-storage. You don't have that in mobile home parks. You get that moat, what Warren Buffett calls a moat around your business, because you have the supply and demand economics working to your favor. The beauty about the park industry is it comes down to the fact you can't develop them. You serve this huge need. Like I said, 60 million Americans need affordable housing and only about 12 million mobile homes. There's about 44,000 parks in the US. And so it just provides that. So if the park rent is $300 lot rent per month and your local house is $1,500 per month, plus way more expensive taxes for the same school, same fire, same everything else, or your local Class C apartment, garden style apartment, well, it's half the price of that. where else are these people going to go? Especially if they're making $10 an hour, they could afford to live in that. Or our biggest demographic is baby boomers. So if 10,000 baby boomers are retiring for the next 10 years every day, 70% approximately only have the Social Security and maybe 25 to 35,000 in their bank. Where are they going to live? They're not going to go to assisted living centers that cost $5,000 a month because they'll be homeless in 6 months. So where they go? Mobile home parks. And our biggest competitor usually is like a Class C apartment. But a Class C apartment, like if you're 65 years old, do you really want to walk up 3 flights of stairs? Do you really want to hear your neighbor's TV? Do you really want to park your car a block away? And do you really want to like just basically have all these inconveniences and less amenities than your local mobile home park? And so they get the pride of ownership, they get the community aspect, they don't have neighbors, they can pull their car up right next to their door, they walk up 3 little steps and they have their own little house. And it's the pride of ownership and all those other benefits, plus they're paying half the price rent.
So there's clearly a constraint on supply.
Yep.
And an increase in demand. Can you walk us through your typical mobile home deal, like how you find it, how you buy it, and what the cash flows look like?
Yeah, so right now it's gotten super competitive because we've seen this year, it's been, okay, for example, in the cap rate compression, we used to be known as 10 cap all across the board, which is really high for real estate. We're usually about 2 points higher, 2 basis points higher than a multifamily, equivalent multifamily, but we've compressed in the last 5 years specifically. Like 10 years ago, you couldn't get Fannie Freddie financing. Fannie Freddie is obviously the best, most advantageous financing. Right now, we're getting lower terms, like high 2s, low 3s. The 10-year treasury right now is under 1 point. We still, most economists are saying that it's going to be still below 1, so we don't see that changing foreseeably. But what that does is provides us with this cushion. So you have the 3 point, like a typical cap rate now is in the 6s for 5s and 4 or 5s in like coastal cities, which we don't go for those because they're just too compressed. But that's the Wall Street deals. But the Midwest stuff you're seeing, which is still a little bit higher cap rate than the coastals, you're seeing for a quality asset 6.5, 7, and then the rates are low 3s. So if you have if your financing is a 3 and your cap rate's a 7, you have 3 plus split between there. That gives you cash and cash in the teens. So it's really attractive in that regard. Plus the benefit of mobile home parks. Traditional commercial real estate depreciates at 39 years. Multifamily, which a lot of people love multifamily, it's 27.5 years. Mobile home parks, the land improvements, most people don't know this, is 15-year depreciation. Plus, if the park owns any of the tenant owns any of the homes, it's depreciated just like multifamily, 27.5. So you have the best tax depreciation schedules, not even including bonus depreciation. You have the higher cap rate, and you have the most stable real estate for the last 50 years and the top performing for the last decade. And then this year, 2020, whenever this airs, but it was by far the best performing of all real estate. So what's happening is you're seeing all these new investors coming in, multifamily guys coming in, and what that's doing is bringing down the cap rates. But still overall, would you rather have something that's producing, we're getting 94% collection rate institutional across the year. Multifamily and some national multifamily magazines during the middle of COVID, 72 to 78%. So I'd rather have something like this. Yeah, the cap is compressed, but I'm still getting 94% collection rate. I'm still getting a higher return, and my property is going up, and I'm getting better tax depreciation schedules. So you're hitting all the boxes while helping people at the same time.
So you're hitting a 6 or greater cap rate if it's not in the Midwest, and then like the coast, or if it's in the Midwest and then along the 2 coasts, those areas they'll get lower, like around a 4 or 4.5.
California, yeah. So for example, there's a Chicago group here that bought a park in Silicon Valley, one park for like I think 238 million. So one park, and I don't even think it was not even that many units. So I think it was like 300,000 a pad. So just to kind of give you an example, Midwest, we like the Midwest because like everything else, it gets slower. We do like Texas, Florida's great, Tennessee. We like where everyone's moving at, the markets where people moving at has strong economic drivers. But it's not just cap rate. It's not just the cap rate. You have the safety and security. So if we know that you have the best, like we have this great Fannie Freddie financing right now, we know we have this peace of mind knowing that we have 94% collection rate, and you're hitting these cash and cash in the teens, and you're getting the best tax depreciation, and it's just, mailbox money, basically. You don't have to worry about anything. And it's been proven. And the worse it gets, the better we do. So that's the beauty.
How much are you putting down on on these typically?
For Fannie and Freddie, they typically want, you could do that, or you could do bank financing is about 2 points higher. But it's coming out to about 33 or 35% all in, and they want reserves about a year now, year and a half, depending on, it all changes based on what's going on with the economy, but about 33, 35%. If you get lucky enough, if you buy a non-institutional quality asset, like say you're buying a smaller park and you have to use traditional small town bank financing, you're probably getting rates in the fives. So your cap rates will be 8, 9, like typically you see those cap rates probably 8, maybe 9 if you're lucky, if you're really lucky. But that's kind of like the range you see.
And then you are now like making this available to accredited investors through your fund. Let's just give people a quick overview of how that works.
Sure. So it's basically fund. The advantage of the fund is you get many investors investing into one asset. So like our minimum is $50,000. You could never get a mobile home park if you put $50,000. Like a minimum, even a small park, you have to put down $250,000. And additionally to that, you have to do all the work, you have to do all the management. So it just saves all that. So it's basically mailbox money for them. I've been in this space 15 years. I was supposed to speak on the national stage with Dr. Ben Carson at the Manufactured Housing Institute. I was one of the 12 speakers. The other speaker was the CEO of Clayton Homes, Warren Buffett's company, the biggest home manufacturer. So you get that credibility. We know the industry. I've been in the space 15 years, like I alluded to. And then we have an all-star team. Our fund administration software has 100 billion under management. They do Apollo groups, I think. Apollo and I think Blackstone. I'm not for sure if they do Blackstone, but I think they do. We also have a park CPA. So we've literally built out the best of the best. And all we do is we acquire, manage, and position for better exits while they get these nice returns. It's quarterly returns, plus their K1s, their tax benefits look a lot better. So we do all the heavy lifting for them, and all they do is collect a check. And that's Midwest Park Capital.
And what's the length of the fund term for people if they invest?
Sure. So yeah, great question. So we're doing 8 to 10 year hold. And the reason we're doing that, it helps for the equity multiple. So the longer we hold it, the better exit we get. So, because we're having the tenants pay down the mortgage, and the mortgage, the longer we pay, hold on to the asset, get a better exit, because the properties, we're going to better operational efficiencies, ethically increase rents, which makes the park worth more instantly. And then over the time, we're paying down the note, so we get that bigger spread. So we get a bigger exit multiple. In 8-10 years, it's just, we want to build a nice portfolio and sell to institutional fund later on, like a Blackstone or Apollo Group, and they're huge in our space. That's another context I didn't mention. Wall Street's huge in our space now because Blackstone they bought the most single family homes in 2009-10 when the last downturn happened. Now they're buying billions of dollars in mobile home parks. They don't buy one or two small, like $3 or $4 or $5 million parks, because they have billions and billions of dollars to buy assets. They're not going to go for scale of economics. They're not going to go, hey, I want to buy this one park for $4 million. But for us, we could scoop all these $4 or $5, $10 million assets, pull together a nice portfolio, and the next thing we know, we turn around and sell it for $40 million per fund, or as we acquire bulk, that becomes appealing to them. But that's our opportunities to scoop up the small deals. And Wall Street's huge in our space now, and I don't foresee that changing anytime soon, just because it's been the top performing real estate for so long.
And what is your target rate of return for investors in the fund?
Yeah, APREF rate, target IRR in the 15s. Like I said, alluded to is the tax depreciation schedule. So look at the most favorable tax schedules. Equity multiples predicted, can't guarantee anything, but like probably 2.5 over the course of fund, as we pay down the mortgage and sell it. So you get all those advantage of that. And the best part is the real value about this play is it's mailbox money. You don't have to do the work. You get a quarterly call. It's all fully transparent. You have an all-star team, fully seasoned. And this industry, which I forgot to mention last time, it's a lot harder to get into now because everyone else is trying to get into it. So it's industry-based relationships. So the people they know, just like in business, know, like, and trust. I've been in this space long enough, all the trade shows. if you're first starting out, you're not going to get, you're not going to get access to the same deal flow from the brokers because they don't know you. They don't want somebody to put an offer on a property and they don't get the financing, or like, oh, I backed out last minute. You'll never get listings or any off-market deals. A lot of this trades off-market now based on your reputation. So it's just getting more and more harder to get in this space. And that's the beauty about us. We have those relationships. We have access to those deal flow. We're talking to people every day, and we can provide that to the investors. So.
All right. Well, it's exciting to see what you're doing in the space, and that you're bringing education and awareness to people about how to get into it, multiple different ways. If they're doing smaller deals on their own or partnering with you on the fund. So thank you for doing that. I know all of the listeners out there appreciate it, and hopefully many of them will take action and get the course or contact you about the fund. Before we wrap up, I always like to do the HyperFast round, if you're ready for some rapid fire questions and answers.
Sure.
All right. What's your biggest piece of advice to a new real estate investor?
Great question. So my biggest advice is listen to podcasts like this. Take on all the free education you have from trusted sources and absorb that. Like allocate a certain percentage every day, because it becomes a habit. Just always have good content and good education coming into your brain every single day, because that's going to give you a foundation. And then get mentors to actually implement it. And then, take action. Start with a smaller, I always recommend do something you could do, boots in the ground, take on a smaller deal, get familiar with the process. Don't go too big. Yeah, you want to, for scale economics, and you want to get big deals, but because, there's more money involved, but at the same time, you don't have the right foundation, you don't have the right education, you don't have the right mentors. It's much better to not lose on your first deal by just taking the right precautionary steps and learn the process, and then move forward and, take action daily, and then move on to bigger and better deals.
What's the biggest challenge you've ever had in business, and how did you overcome it?
Oh, that definitely was the last downturn. So I thought I was prepared for the last downturn. That's when I first got into entrepreneurship. Like I left BB, and that's when I went from 150 a year, which is basically like 200 a year nowadays, to getting right into real estate when it was impossible to sell deals. So going from a healthy income, even though I saved a lot, to seeing everything go to like a complete standstill while reinvesting into my business. But then I was fortunate enough that I spent allocated all my time into mentors, learning the park space inside and out, and then also learning digital, which has really positioned me well for this downturn. So I'm not in a bad way, but the next recession or upcoming recession, which is probably pretty intimate because we printed so much money. 21% of the money's been printed last year, and all the dynamics of closing businesses for 3 to 6 months at a time. There's always going to be something that's going to happen later on. There's always an action that's going to happen later on. I'm really prepared for this one, and I have, the right vehicles to move forward. So I'm glad I learned early to be positioned for the next, 2021 and 2022, recession.
What would we find you doing when you're not doing real estate?
So I'm an advocate of just education. So I allocate at least 3 or 4 hours a day. Like people don't even believe, but I literally do. I wake up in the morning, 6:30. I just literally throw a podcast. I do a Scribe, the app for books. I did 115 books last year. And that just really gives you a competitive advantage. Like when you just have that knowledge, you could see, I've been studying historical figures like Sam Walton, Henry Ford, like all the guys from different generations. They've gone through different economic challenges. They've had different challenges and how they overcame it and how they solved those problems. And not just in the business side of it, but also like in your daily life. You can implement all these education that's out there and then put it into your life. It really makes a huge difference. So that, and then working out, I'm a huge advocate of working out. Because at the beginning of the year, I was just working 90 to 100 hour weeks every week, and I didn't take time for myself. So I started allocating about an hour and a half, 5 or 6 days a week towards working out, and I lost like 35 pounds. So that was good.
Awesome. Well, congrats on that. Last question, where do you see yourself 10 years from now?
10 years from now, I probably will have different solutions. I'll probably be on closing out my third, we want to do 3 funds in the next 5 years, but we'll be closing out at least 1 or 2 of them by that time. Also, I'll definitely be in Miami for sure. And then maybe having second passports and being positioned in other states, depending on what happens with, the U.S. economy. I want to be able to be, have banking, in Singapore. I want to have different locations where they treat you best, because as an entrepreneur, we're solving these problems, but now we're getting some of these, some of these laws are coming on and are really punishing us as, entrepreneurs and reinvesting our business. So where can we go to, get treated best and position your assets for asset protection, and also where we could get really treated best as being an entrepreneur? Because like the U.S. has been, as we saw this year, where I feel bad for these restaurateurs, like they cannot, New York right now, they have to eat outside in the middle of the winter. Like, if that's how they're going to treat this, I know COVID's a huge thing, but what are we going to do to solve these entrepreneurs are going to lose everything. So they've family, multi-generations of business owners where they're losing everything. I don't want to be positioned where the U.S. government can, close me down at any time whenever they feel like it.
Yeah, I agree. It's a problem when the government is picking who's essential, who's not, who can work, and who knows if it even makes a difference. Like I'm down in Florida, it's a lot more open than most states, and the numbers per capita aren't any worse than some of the states that have the most stringent lockdowns. But so I definitely think that it's prudent for successful entrepreneurs or people that think their success will be expanding to think of ways to protect yourself in the future from all sorts of scenarios. And this year for many has been a wake-up call for that, certainly.
Yeah, 100%. And I just, like, Chicago is a big culinary city. It's a ghost town. If you walk outside, it's like sad. Like especially like the smaller 1 or 2 locations, they're all shuttering. So your options are the chains. And Chicago is not like, you don't have like every block like Taco Bell and McDonald's, but like it's probably going to come down to that. To replace the old, great chef-driven restaurants, and replace it with these corporate companies. It's just a sad situation. It's bad, man. So that's why I want to make sure that being a producer, being a problem solver, that we create, we're entrepreneurs, we create our own destiny. Who's going to treat us best, and also positioning for future. And that's why I'm fortunate to be in the park space. It's the most resilient. And then also being digital, that's where we're seeing such a rise in crypto. Like, it's crazy this year. Like I think there's gonna be a pullback on it, but Wall Street's pouring money into crypto because they don't trust how much money's been printed by the U.S. government. So there's going to be, they printed so much money. It sounds great and people needed it, but at the end of the day, it's going to make the richer richer and the poorer poorer over the next, 20, 30 years, where the value of money has been so depreciated due to the fact that we print so much money. It's going to be a lot of things are going to change in the next 7, 10 years. So I just recommend people making sure they understand the economics, where the direction's going, and also positioning their assets and asset protection in the right vehicles that gives them that stability and security and peace of mind at the end of the day.
Yeah, I would agree to start thinking in terms of buying real assets, and real estate's one of the best ones to counteract these inflationary pressures that are certainly going on. And I think, if you're a entrepreneur, business owner out there, whatever space you're in, if your business is down, I think a good way to counteract that would be to get that mobile home park course and see if this is something you can do as a side hustle starting out, maybe, and then move up to the smaller parks or get involved with the fund. You've certainly given people a lot of ways to build wealth, so it's exciting to see that, and it'll be exciting to watch this journey, and hopefully you help a ton more people. So thank you for being on the show today, and the insights, the value you provided. Before we sign off, just remind people how to get to the course or how to contact you if they want to learn more about the fund or just connect with you on social media.
Yeah, so the fund is midwestparkcapital.com. That's more like a general, gives like a basic premise of the industry. And you can fill out a form there to get to view the PPM. But if you're already accredited and you're super interested and you want to see the private placement, which basically breaks down the company, the market, what we're doing for our business objectives, that's midwestparkcapitalfund.com. That's the two websites for the fund. And then not including the funnels, which is like, online sales pages, but the login page, which I actually could, fill out a form to get information as it comes out, is mobilehomewealthacademy.com, mobilehomewealthacademy.com. And then just Facebook is Jonathan Tuttle Official, and I think Instagram, Jonathan Tuttle.
All right. Well, thank you for being on the show, Jonathan. For all the listeners out there or viewers on YouTube, thanks for tuning in. We'll see you next time.
Hey guys, thanks for sticking around to the end. If you want to see more videos like this, click right here. And if you're new to the channel, click below to subscribe and turn on post notifications so you don't miss out. And let me know in the comments what you think about the videos. I'll see you next time.